Good morning. You're watching Market Cafe on ET Now with me, Shreyansi Singh and Snehi Shah. And over the next 1 hour, we will take you through news and updates from within the country as well as across the globe, tell you which stocks you should keep on your radar and tell you what the brokerages are saying as well. But Snehi, first off, we must be looking at the international handover because what a day and what a week we've seen coming for the Wall Street, right?
Absolutely, lots of volatility coming in, and not only across Wall Street. You have Asian markets that are lagging. Europe, on the other hand, is holding up pretty well for itself. And commodities are in question. Oil and gold. We've seen a lot of volatility and lots of big moves coming in over the course of this week. But with that, let's kickstart the show with the handover coming in from Wall Street and the European markets. Now let's talk about Wall Street first. Stock futures ticked lower in overnight trading yesterday as the S&P 500 is headed for its worst week in almost 6 months. The S&P 500 has fallen for 5 sessions in a row, bringing its week-to-date losses to 2.2%. Now, it would be the large cap benchmark's third straight negative week and its biggest losing week since 27th October 2023. So that's last year. The S&P 500 is now almost 5% off its 52-week high as well. The market pullback has been largely driven by tempered expectations for a rate cut soon. Economists and strategists now see the Fed waiting until at least September to lower rates and are increasingly entertaining the possibility of no reductions at all this year. This comes after we had the Fed Chair Jerome Powell. He spoke over the course of the last few days talking about how they might have to hold back on those rate cuts. After all, you have various FOMC members, various presidents of various FOMC's divisions that they've been also talking about not seeing any rate cut this year as well, as long as the inflation data is in place, at least until the inflation data is in place. So, that's what's hampering the markets as of now. And one big news maker yesterday has been Netflix. Now, Netflix shares have fallen more than 4% in extended trading, even after the streamer reported quarterly earnings that were beat on the top and bottom line. Both, we'll tell you more about this over the course of the show as well. Let's come back and talk a little bit more about the markets. The blue chip Dow and the tech-heavy Nasdaq Composite are also poised for a losing week, falling almost 0.5% and 3.5% so far, respectively. Nasdaq is on pace for its 4th straight down week, the longest weekly losing streak since December of 2022. Companies expected to report quarterly results today morning include consumer product giants like Procter & Gamble, oilfield services named SLB, and financial services firm American Express. This is obviously morning of US timing, so when Wall Street opens early in the morning in the US. But while this was the handover coming in from the US, when you shift focus and look at Europe, very interesting moves coming in over there, because Europe as of now is entirely in the green, exact opposite of what Wall Street has been up to. DAX is up 0.4%, FTSE is also up 0.4%, and the Pan-European Stock 600 index is also up 0.3%. While they're not big moves in the green, they're in the green nonetheless, and completely opposite to what the US did yesterday and what Asia is doing as of now. So some relief when you look at the screen when it comes to European markets, but other than that, US markets are all set to end the week in deep cuts with the red bar. Shreyansi, with that, also take us through what crude is up to, what gold is up to. These two have also been largely in focus over the volatility that we've seen on the equities front. Both of them have also been in focus, so tell us what's happening.
Absolutely, and it's very interesting to see what is playing out in the oil markets on a daily basis and as well as a weekly basis, because what you're seeing right now is that crude oil futures were mixed after a sell-off earlier in the week as traders discounted fears of a war between Israel and Iran that could disrupt crude supplies. So when you're looking at price action, then WTI contract added just 4 cents, settled around that $82 a barrel mark, and Brent as well lost 18 cents or 0.2% thereabout and settled around that $87 a barrel mark. Now, US crude oil had gained nearly 1% to a session high of $83.47 before pulling back. And oil, in fact, sold off more than 3% earlier this week as Israel has refrained so far from striking back against Iran for the Islamic Republic's unprecedented weekend air assault as well, reducing fears of a major war in the Middle East. Now, US crude oil and the global benchmark have fallen below the prices reached after Israel's airstrike against Iran's diplomatic compound in Damascus, Syria at the start of the month, the event that triggered the current round of hostilities. Meanwhile, the Biden administration has imposed new sanctions against Iran's missile and drone program, but the punitive measures have spared the Islamic Republic's oil exports for now, and that is something that the market is definitely looking at very closely. In addition to the fading geopolitical risk premium, then, prices have also fallen this week on a 10 million barrel build in the US petroleum inventories last week, and that is also something that the market is looking out for. But then, when you're talking about geopolitical tension and geopolitical tension premium, we must mention safe haven gold because that has gained as persistent tensions in the Middle East added to the metal's appeal despite robust economic data from the US that raise prospects of fewer interest rate cuts. So when you look at price action for gold, spot gold gained 0.9% and was around that 2,382 per ounce mark. Mind you, prices did touch an all-time high of 2,431 last Friday. So we've seen some elevated levels come in and good price action on a daily basis and a weekly basis for gold, but can't say the same about oil at all.
Well, absolutely spot on, very well put, and very well summarized with everything that's been happening. But with that, let's also take a look at what's happening across India and across the world. What are the important events that you need to be watching out for in and outside of the markets? Well, big day for India today because it's the phase 1 of Lok Sabha elections that's kicking off today. We're headed to the polls now, and polling is beginning in 102 constituencies across 21 states and union territories today. So, well, India's headed to polls, and it's an election to watch out for. Moving on then from India, we also have Forex reserves data coming out today. Shifting focus globally from the US, you have Fed's balance sheet that will be released today, and the Baker Hughes oil rig count will also be out today. From the UK then, you have retail sales numbers also coming in. And when you shift focus back home, let's take a look at the earnings that we have lined up for today. From the Nifty pack, you have Wipro coming out with its numbers today after TCS last week and Infosys yesterday. Remember, TCS was stellar, Infosys was under expectations, so we'll see what Wipro does today. On the other hand, from the non-Nifty pack, you have HDFC AMC, Hindustan Zinc, Geo Financial Services as well as Premier Explosives all slated to release their Q4 as well as FY24 numbers today. On the corporate action front, a whole host of board meetings taking place today. Schaeffler India's annual general meeting will be taking place today, so we'll keep that stock in focus today as well. Elecon Engineering, that board will also be meeting to mull results, dividend as well as stock split. So, well, we'll be keeping a close eye on Elecon Engineering as well. In terms of other news, then globally you have the CPI data coming out from Japan. That will be out anytime soon now, and we'll see how that pans out on the Japanese market because that is not doing very well right now. Nikkei is down with sharp cuts as we speak. On the other hand, you have FOMC members Raphael Bostic and Austin Goolsbee. They will also be speaking, so we'll be watching out for all of these key commentaries as well, Shansi.
Absolutely, and then let's start today's morning by looking at two important commentaries coming in from Fed officials on the most awaited US rate cuts this year. Atlanta Federal Reserve President Raphael Bostic said that the US inflation is going to return to 2% but at a slower pace than expected. Meanwhile, Minneapolis Fed President Neil Kashkari, who will not be voting on monetary policy decisions this year, reiterated his stance on rate cuts and said that more data is required to be confident about inflation before cutting interest rates. He also adds that the Fed could potentially hold rates steady all year.
Well, moving on the other hand, IMF Chief Kristalina Georgieva urged Asian central banks not to follow Fed too closely and focus on domestic inflation. She added Fed is doing the right thing on rates and should not hurry for rate cuts. She also said that if central banks follow Fed too closely, they could possibly undermine price stability in their own countries. The current remarks underscore the dilemma some Asian central banks face as the recent Fed-driven currency market swings complicate their own policy path.
Moving on then, in the global earnings front, video streaming giant Netflix reported a stellar Q1 earnings and added 9 million plus subscribers in the quarter, although they gave a disappointing second quarter revenue guidance which dragged the stock more than 3% lower in after-hours trading. Notably, the company also said that they will stop reporting quarterly membership numbers starting next year, along with average revenue per member. Mind you, this is a number that they've prided themselves on reporting. They've been reporting regional numbers for streaming subscription data as well. And this is an important move coming in from Netflix then.
Well, we'll see how the street reacts to this announcement made by Netflix, but let's move on. Then global tech giant Google has terminated 28 employees who had participated in a sit-down protest over the company's $1.2 billion agreement with Israel. The dismissals followed a series of events in which employees marched to the office of Google's top cloud executive in California, while others held sit-ins in Google's New York City headquarters.
Well, today marks the commencement of the 2024 Lok Sabha elections, with the first phase set to unfold across 21 states and union territories. A total of 102 Lok Sabha seats will go to the polls in this initial phase. This includes all 39 seats in Tamil Nadu, Uttarakhand and Assam. The counting of votes will be held on June 4th.
Well, that's the biggest event taking place in India right now. But the other thing that's been gaining our attention is the sweltering summers, right? Because despite the soaring temperatures, Indians are unwavering in their pursuit of vacation bliss. With a penchant for cooler locales, destinations like Kashmir, Shimla and Bhutan are topping the charts. Beach getaways to Andaman are also in vogue. Surprisingly, Bhubaneswar is emerging as a domestic origin hotspot. Closer to home, Aurangabad, Varanasi and Gaya are drawing cultural enthusiasts. Now, with upcoming events like Olympics, demand is expected to soar. Airlines are expanding fleets to meet the rising travel demand. My colleague Astha Chopra filed a special report on just this. Listen in.
Despite the looming heat waves, India remains unstoppable in their quest for vacation bliss. Indians are actively planning their vacations this summer. According to IndVentures, with a preference for cooler destination, popular choices includes Kashmir, Shimla and Bhutan, offering respite from heat. Beach getaways like Andamans are also favoured. Interestingly, Bhubaneswar has emerged as a rising domestic origin city. Internationally, Thailand, Vietnam and Sri Lanka are trending for their tropical climates and cultural offerings. Goa, Srinagar and Mumbai as the top searched destinations as well. The survey also shed lights on the emerging travel trends. Tier 2 cities like Pune and Patna are gaining traction among Indian vacationers, showcasing a desire to explore new and unexpected locations. There is a good news for the travelers as there are no significant price hikes for air tickets. Trips from Mumbai to Srinagar cost about the same, which is approximately rupees 11,000 whether you book in April or May.
Even above last year, the numbers are showing an uptrend. So that's an interesting observation that we have. Now, other destinations that are being looked at are warmer beaches. And there, I think at a domestic level, Andamans and a new destination that's emerging is Bhubaneswar. And then, of course, there is the culture and religion type of destinations, which are like the new one that's emerging is Aurangabad.
With around 25,000 new rooms in emerging markets like Ayodhya, Varanasi and Deoghar, which are contributing to the demand. On the contrary, with increased demand, the price of hotels sees 7 to 15% price hike. According to Mercury Travels, the demand during May to July will increase due to Olympics in Paris, which people have already started pre-booking the flights, and also due to the football matches, which will begin in July. To cater the all-over rise demand, several airlines have announced fleet expansions, while the government initiatives to develop new airports and airlines like Indigo and Air India have ordered more than 1,200 aircrafts.
Alright, thanks Astha for that roundup. Time for a quick break then. When we come back, we'll take a look at how the Asian markets are shaping up. Welcome back. Thank you so much for staying tuned in. Well, let's take a look at the Asian markets then as promised. And Asia Pacific markets were all lower, tracking Wall Street's losses overnight and giving up gains from the previous day. Japan released March inflation data with the headline inflation rate coming in at 2.7%, down from the 2.8% seen in February. Japan's benchmark Nikkei on your screens was down previously 1.8% after the inflation reading. Right now, the cuts have deepened, and Nikkei is down about 3% thereabout, and Kospi as well. Then let's take a look at that one as well, and that was 1.8% lower after leading gains in Asia on Thursday. Currently on your screens, down 2.4%, a deeper shade of red for this index as well. Now in Australia, we've got the ASX 200 that was nearly 1% lower. Currently, the cuts have deepened even for ASX 200 and it's down 1.5%. Let's take a look at Hang Seng and Shanghai then. Hang Seng is also in the red, 1.5% of a downtick coming in for Hang Seng. Let's also take a look at Shanghai then, and Shanghai is down just a little bit and currently not doing all that much, just a negative bias coming in for Shanghai. But we've seen quite the move come in for Nikkei, which is seeing deep cuts of red. Now back home, we closed around the 21,995 mark. And currently, what the Nifty implied is indicating is a very bad start for us, a gap down open, both on a spot and futures basis. Of course, on a futures basis, it is not looking like a very bad open, but on a spot basis, deep cuts coming in is what the Nifty implied is penciling in at this point.
Well, absolutely, and let me take you through something that's been happening right now. We've just received news, and this is a breaking news that we're getting in. You can also see that on the ticker coming in. Israeli missiles have hit sites in Iran. This is what US agency officials are saying. Of course, we've been getting all these news from reports. These are reports-based news. Israeli missiles have hit a site in Iran. This is what reports are showing. On the back of that, if you look at GIFT Nifty, there's been a sharp downtick in GIFT Nifty. 260 points lower is where the GIFT Nifty is showing. More than a 1% cut. Let's take a look at what's happening globally also on the back of this news flow. Immediate impact is being seen on some indices. US 10-year Treasury yield is more than 13 bips lower to 4.5%. That has fallen. We've seen a sudden spike in oil coming across. When you take a look at it, Brent oil futures, they've just come back below 90, but they had crossed that $90 per barrel mark, a 3.3% uptick coming in Brent crude. Shifting focus, even when you talk about WTI crude, that has also surpassed the $85 per barrel mark right now, a 3.5% spike coming in over there as well. So, on the back of this breaking geopolitical tension that we've been seeing developing, and on this development, all of these indices are spiking upwards. On the other hand, GIFT Nifty falling as we speak. 265 points lower is what our opening is being indicated as today. Hi there, welcome back. You're still watching Market Cafe with us on ET Now. Let's talk about the big newsmaker yesterday post-market hours. We had the numbers for Infosys come out, and IT bellwether Infosys delivered a miss on all counts in the final quarter of FY24. Even the beat that came on profit was largely led by other income. Let's go across to my colleague Anisha Jain for a fine print of those numbers and what disappointed the street so much. Anisha.
Well, Infosys reported another miss in the quarterly earnings, and a big disappointment at that. The constant currency this quarter declined by 2.2% as compared to our expectation of just a 0.4% decline. So a sharp miss on the top line itself, and that trickled down into the operating performance, with the margin coming in at 20.1% versus expectation of 20.7%. So on a sequential basis, there was actually a decline in margins versus the expectation of an expansion. Profitability, however, optically is looking much better than expectation at over 7,000 crores. But do remember, the other income is actually higher, and that's the reason you're seeing a profit beat. But otherwise, it's operationally weak quarter. Not just that, even in terms of guidance, there's a sharp miss coming in. The company is talking about a growth of just 1 to 3% in constant currency in the coming year, that is FY25. This is much lower than what Street was expecting. Remember, part of the Street had factored in a 3 to 6% kind of growth guidance as well, and the weakest on the Street had an expectation of at least 2 to 5%. So 1 to 3 is a big departure, at least on the higher end of the range versus the Street expectation. The dollar revenue also came in at $4,564 million, below our expectations. The profitability, as I talked about, was just better on account of one-off. Though the deal win number is quite strong, $4.5 billion is actually much ahead of expectation, because Street was talking about a number of maybe $2.5 billion. So that's the only silver lining in the number, because other than that, it is a big miss coming in across the board. The management says that they are looking at excellent traction from clients in generative AI, and of course they've announced an acquisition as well of almost 450 million euros, but the ADR is already reacting negatively to the big miss that we have seen coming in from Infosys this time around.
All right, thanks Anisha for that update. Let's also listen to what the management had to say as well.
On the revenue, what we are seeing is the environment in terms of discretionary and digital work is similar to what we've ended in this year. We also had good traction in large deals, some of which will flow through in the next year, given the duration of those deals. Keeping that in mind, our growth guidance for next year is as a band higher than where we finished for this year. While the difference is small, it's still higher from where we finished this year. As we go into the industries, we see, for example, financial services to see a better outlook in the next year compared to the past year. And given the outlook with the discretionary spend and digital work remaining same and more focus on cost efficiency and consolidation, we've created that revenue growth guidance.
On the net headcount increases, if you look at it, when we started the year, we were at 77% utilization, including trainees. The growth environment also was different at that point in time. We had guided differently. So, we had to realign some of those factors as the growth environment changed. Our utilization has now gone up to 82%, including trainees, 83.5%, excluding trainees. That's one of the tracks under Maximus as well. Our attrition has also come down significantly, right? So that's the reason why you see a net headcount reduction. And we also have changed in last few years our hiring model significantly. So we no more hire all the freshers for campus. We hire less than half of them from campus, and the rest we hire off campuses. So we have that agile model. So we will look at hiring as the year goes through.
All right, that's the word coming in from the management at Infosys, but here's the brokerage verdict as well. Now, we have UBS and Investec, two notes coming in on the brokerage front this morning. UBS has maintained their buy stance. Investec has still continued their hold stance. Earlier target for UBS was at 1800 rupees, but now they've gone ahead and cut the target price per share to 1700 rupees. Similarly, for Investec, they've gone ahead and hiked the target price earlier at 1540, and now they've hiked it by 1000 rupees at 1640. Interesting moves. UBS has cut the target price by 1000 rupees, and on the other side, pardon me, I believe there is a mismatch in the numbers. Investec on the other side, let's take a look at what Investec has done. Investec have also gone ahead and cut the price to 1540 rupees from 1640. That's my bad, pardon me. Let's get a move on then and look at all of these brokerage notes in detail. When it comes to UBS, then they've maintained their buy rating, gone ahead and cut the target price. They believe that quarter 4 results of Infosys have come in lower than expected. FY25 guidance also looks disappointing, but looks conservative given strong deal wins, and they believe that the market has already positioned itself for a disappointing performance, and hence they're seeing limited downside from here on going ahead. Moving on then, let's also take a look at what Investec has to say. They've maintained their hold rating, gone ahead and slashed the target price by 1000 rupees, as you can see. They say that revenue guidance is looking weak despite record deal wins, and that is owing to longer tenure deals and weak discretionary spend environment. It's difficult to predict a recovery in discretionary spends, but based on what we've seen in the past, it is usually sudden, and they're asking if the worst is over. And while it's difficult to say for Investec going ahead, they believe that Infosys will be a big beneficiary when discretionary spends return. But until then, they've gone ahead and maintained their hold rating. So largely, this is what the brokerage verdict is on Infosys on the back of its quarter 4 numbers.
Absolutely, and we'd definitely be keeping an eye on Infosys, but we'd also be keeping an eye on Bajaj Auto because they came out with its Q4 earnings and it has performed quite well. When you look at profit after tax and revenue, both have come in above estimates. My colleague Srishti is standing by with the earnings fine print. Srishti, tell us a little more about what the numbers were like.
Well, Bajaj Auto came out with a decent set of earnings this time, majorly in line to what we were expecting at ET now. The revenue came in at 11,485 crores, EBITDA clocked in at 2,305 crores, and the margins were almost flat on a YOY as well as on a quarter-on-quarter basis at 20%. Talking about the profitability, 1,936 crores is what the company has reported, slightly better than what we were expecting at ET now. But some of the internals look quite positive, because the company did say that the margins held steady despite the significant investments on expanding their electric scooter business. The 125cc plus segment has been doing really well, and that registered 4 times growth versus rest of the industry in the quarter gone by. The commercial vehicle sustained its sales trajectory, more than 1 lakh of sales being clocked yet another quarter. In the E3 wheeler, the company did expand its network to 60 cities now versus 23 in Q3, and the Chetak also delivered its highest quarterly volume. Talking about the Triumph volumes, that has also stepped up further, nearly 18,800 units being delivered in this quarter, and 70% of the volumes is going in the overseas market, and the company is also working to unlock the capacity in the next few months, specifically for the Triumph to cater to the demand in the domestic as well as exports market. So all in all, a decent set coming in from Bajaj Auto. The commentary is quite positive as of now, and the numbers were seen to be in line.
All right, well, Shrishti, thanks so much for taking us through that. A good set of numbers coming in from Bajaj Auto, a beat on terms of revenue and PAT as well. Let's take a look at what brokerages have to say. Let's start by looking at what Macquarie has to say. They've maintained their neutral rating with a target price of 8,405 rupees. They believe that better realization will drive earnings beat, and strong product launch across multiple powertrains has also aided the results this time. Triumph capacity expansion to 10,000 units is on track, and this is also likely to happen with new product launch plans as well. So this is largely what Macquarie has to say. We're just getting word from two other brokerages. Then Citi has maintained their sell rating, but they've gone ahead and hiked the target price to 6,500 from 5,500, a 1,000 rupee hike coming in over there. And on the other hand, we're also getting a note from JP Morgan. Then they've maintained their overweight rating and have hiked the target price to 10,000 rupees from 8,900. So that's a bigger hike that's coming in from JP Morgan as well. So well, this is largely the brokerage verdict coming in on Bajaj Auto quarter four numbers as well.
Well, absolutely, and we'll be keeping an eye on Bajaj Auto in the trading session today. But moving on then onto an ET Now exclusive, Mumbai's Urban Development Authority, MMRDA, is in the process of acquiring a 74% equity stake from Reliance Infrastructure in Mumbai Metro 1. Now, reliable sources told ET Now that the acquisition value is seen around 4,700 crore rupees, and this is on the heels of NCLT's disposal of insolvency petitions against Mumbai Metro 1. Anurag Joshi is standing by with more details. Anurag?
Mumbai's Urban Development Authority, MMRDA, is in the process of acquiring a 74% equity stake in Mumbai Metro 1 that runs the busiest metro rail line in the country's financial hub from Reliance Infrastructure. MMRDA owns a 26% equity stake in Mumbai Metro 1. Reliance Infrastructure is owning the remaining 74% equity stake. Now, sources have told ET Now that MMRDA is likely to acquire the holding for around 4,700 crore acquisition value. And this comes on the heels of NCLT Mumbai bench ruling, which had disposed of the insolvency petitions against Mumbai Metro 1, and this removed a key hurdle for the stake sale to take place. Now the NCLT Mumbai bench has withdrawn MMOPL, the Mumbai Metro 1, from the insolvency proceedings in view of the one-time debt settlement with banks led by State Bank of India and IDBI Bank. In March, the Maharashtra government had cleared the stake sale proposal to MMRDA, and the money that Reliance Infrastructure gets from the deal will help generate cash that could help the company repay some of its debt obligations.
Let's get a move on then and talk about the health insurance segment, because if you pay your health insurance premiums continuously for 5 years, your insurance company will not be able to reject claims citing failure to disclose your health status. This is as per insurance regulatory IRDAI, as it tweaks some crucial norms for the health insurance policies. My colleague Anurag Shah is joining us with more details on this. Anurag, very interesting news coming in over here, very positive for policy premium payers as well. So take us through this.
This is a positive development for health insurance policy holders. If you are paying your premium for continuous 5 years, then your insurer cannot deny claims saying that while buying the policy you have not disclosed all details, or there was a misrepresentation at the beginning, because IRDA has reduced the moratorium period from 8 years to 5 years. Another development is that waiting period has been reduced from 4 years to 3 years. So for pre-existing disease, while buying an insurance policy, if you are disclosing any pre-existing disease, then after a period of 3 years, which is maximum 3 years, waiting period can be there for any pre-existing disease, and after that insurers are supposed to give claim for pre-existing disease. Other than that, under the new product development rules, IRD has given a freedom to insurers to design product for senior citizens, for children and for women. So going ahead, you'll see a dedicated product for senior citizens above age of 65 also. So these are the important changes IRDA has come up favoring policyholders, especially in health insurance sector.
All right, thanks Anurag for all of those details. But time for a quick break then. When we come back, we'll take a look at some more stock-specific news.
Hi there, welcome back. Let's keep it with the turmoil that's happening in the Middle East. Then, as you can see, it's flashing on your screen now. We have confirmed reports of several blasts happening across Iran. But on the back of that, I also want to mark what's happening in the US. A pre-open market, Dow futures are lower by 1.1%, S&P futures lower by almost 1.5%, and Nasdaq futures are below more than 1.5% at 1.6% cut coming in. So, well, we'll see how that pans out for Wall Street as well. For our markets also, steeper falls coming in, a 320 point cut indicated for us. So Shreyansi, we'll just have to wait and watch at how the market opens today. But let's come back and let's keep it with the programming. And we're now being joined by my colleague Ansh, who's here with the FNO snapshot for today. Mind you, it was expiry day yesterday and lots of geopolitical action being seen today. So on the back of that, Ansh, tell us what the derivative snapshot looks like.
Right, so starting with Nifty first, index has slipped below its 50 DMA. It has been declining for fourth consecutive session, as well as you mentioned that there are some global tensions as well. But the good thing is that we have good support at around 21,850, which has been intact from last 2 months. So as long as we stay above that on a closing basis, we can have some positive bias into the market. But if we talk about index options, then we are seeing call writing happening at 22,200, indicating strong resistance around this level if we see an up move, whereas on downside, there's put buying happening at 22,000 strike price, indicating traders expecting Nifty to stay below this level for today's session. Moving on to Nifty Bank. As you can see in the chart as well, the index is actually moving within its upward sloping channel, and it is currently near the support. So this also keeps a positive bias into the market till that 46,800 to 46,900 stays protected on closing basis. On option front, we are seeing call writing happening at around 47,800, indicating traders expecting index to face some selling pressure if we see an up move in today's session. Let's also talk about what FIs did in previous session. In index futures, they covered 26,000 long contracts. They added around more than 44,000 short contracts. This is the biggest short addition seen in at least 3 years. Due to this, the total net has come down by 71,000 contracts. If you'll see a total FI long position, it has come from 43.7% to directly 32.5%, showing FII's strong bearish stance into the market. Let's have a quick view on FNO stocks as well. That will be in focus, and we are seeing good, strong long build-up happening in trend, whereas short build-up for Apollo Hospital and India Mart. So keep an eye on the stocks.
All right, Ansh, well, thanks. We'll definitely be keeping an eye on all of those stocks. But while you're with us, tell us a little more about which stocks are on your radar and which are likely to remain in focus on the back of news flow then.
Right, so ITC will be the first stock in focus, as ITC Infotech India, a wholly owned subsidiary, has entered into share purchase agreement for acquisition of 100% of share capital of Blaziken Technology Private Limited. The total consideration for which is around 485 crore. Apart from this, GMR Airport will be in focus on the back of its monthly traffic data that they have shared, and it has crossed 120.8 million pax mark. This is the highest ever pax traffic, which is up by over 20% on year-on-year basis. Also, the domestic traffic is up by around 17% on year-on-year basis, and international traffic has jumped up by over 33%. Hinduja Global Solution is also in focus, as 1TT International Limited, subsidiary of the company, has entered into a agreement to acquire around 51% shareholding of 7-Star Balaji Broadband Private Limited. RVNL is also in focus, as they have signed MOU with Turkish engineering and consulting and contracting company Tumas India Private Limited for partnership and collaboration in public transportation projects and infrastructure projects in India. Torrent Power is also in focus as the company has entered into share purchase agreement for acquisition of 100% equity share capital of the SPV from the seller starting from 18th April. Lastly, Industar will be in focus as NTPC Green Energy has signed MOU with Industar Limited. MOU is to explore joint venture development of grid-connected renewable energy-based power project, including solar, wind, energy storage, etc. So keep an eye on the stocks.
Alright, Ansh, thanks so much for taking us through this list. But yet another stock that will be on everybody's radar today is going to be HDFC Bank, because that major banking major is all set to report its quarter four earnings tomorrow. Net interest income is expected to jump on a year-on-year basis. So what else is the street penciling in? What can we expect from the numbers? Gaurav is here with all of those expectations. Good morning, Gaurav.
Well, yes, HDFC Bank will come up with the results soon, and Street is definitely expecting some good set of numbers from HDFC Bank, because if you look at the provisional update that the bank has provided, we have already seen the advances growth of 1.6% on a quarter-on-quarter basis, while deposits, which was actually in focus, grew almost by 7.5% on a quarter-on-quarter basis. Even if you look at CASA ratio, that improved by 50 basis points to 38.5% according to the provisional updates given by the company. And if you look at the Street's expectation now, they are expecting net interest income from here on to increase almost by 2% on a quarter-on-quarter basis, which will reflect a growth of almost 24% on a YY basis. And they are expecting net interest margin to contract a little by 5 bips in this quarter, and this may result in 3.35% of net interest margin during 4Q FY24. Now, what they are also expecting is that this will be a reason, the LDR will be a reason for this contraction in net interest margin. So they are expecting LDR to be somewhere around 105% versus what we have seen at 110% in 3Q FY24. And lastly, they are also expecting some non-interest income to boost the profitability for this quarter. So we know that HDFC sold its stake in Credila, and this is going to give boost of around 9,000 crore rupees to its PAT, which will drive the PAT growth to almost by 23% on a quarter-on-quarter basis during Q4 FY24, and the street is expecting ROA to remain above 2% because of this reason. Lastly, if you look at the expectation from the street now, the investors are expecting some kind of commentary on the trajectory of earnings from HDFC, because management had given a clear signal that they will be focusing more on EPS growth rather than loan growth from here on. Next, we will definitely look out for net interest margins trajectory for FY25 and any kind of comments on the deposits growth, because we have seen that the deposit growth was strong for Q4 FY24, but this is very key for a bank that this deposit growth rate should sustain from here on as well. So definitely keeping an eye on how the commentaries come from HDFC Bank, but for now this counter is definitely going to be in focus.
Thanks, Gaurav. So come tomorrow, we'd definitely be watching out for the numbers of HDFC Bank. But that's all the time that we had on this edition of Market Cafe on ET Now. From me, Shriyanshi Singh, Snehi Shah, as well as the entire team that put this show together, thank you so much for tuning in. Don't go anywhere, because the market takes all of the action forward.
If you like this video, then like, share and subscribe to ET Now.